Pradeep P. Shah, Chairman of IndAsia Fund Advisor, joins us live. Pradeep, good morning. Thank you for joining us. Pradeep, at the current juncture, it's very easy to make a bearish argument. Nothing is going our way. Currency has plummeted, GDP has slipped, earnings are unlikely to revive, and valuations are still very rich. But best trades or best investment are always made when there is outright gloom and doom.
Yes, I agree. There is a great opportunity for a contrarian strategy. And I'm not completely pessimistic that things will not turn around. I think we have done substantial damage. There will be some structural damage, but some of it now can be reversed. We have a new governor coming in. The government is conscious of steps to be taken. And if you look at our current problems, we have a current account deficit, we have a fiscal deficit, we have very high interest rates to address some of the issues that we have seen in currency and inflation. Now, interest rates are a blunt instrument. They hurt speculators in the rupee, and that's really not the cause of currency depreciation. It's the current account deficit and the catch-up in inflation. If you look at the past history, from 1982 to 1992-93, over that 10 years, we had a currency depreciation of 12.2% compounded per year. In the next decade, it was down to 4.6%, and in the subsequent decade, it was 1.2%. Now, if you extend that last decade's to current situation, even then, the currency depreciation is just 2.7% per annum, which is far less than the interest rate the inflation differential between India and the Western world. And so there is some catch-up built into this. In addition, we have a current account deficit. So therefore, the currency had to, at some way, give. And the trigger was the QE easing or tapering off that was announced in May. Then we compounded our problems. For instance, increasing interest rates, which actually hurt the economy and investor sentiment domestically and internationally, and also consumer sentiment. So very high interest rates and very tight money have actually damaged investment in power and other projects, and as well as reduced consumer durables demand, auto, housing, and so on, have been affected. So here's an opportunity for the new governor to actually aggressively go on interest rate reduction and open up the FCNR tap by allowing our banks, which already have the distribution in the Middle East and elsewhere, to bring in foreign currency non-resident deposits by giving them an incentive, reduce the SLR and CRR requirements against those deposits, and give them a little higher, give the investors a little bit of a higher interest rate. And that can open the tap, and so we can stabilize the currency. In addition, we should also complement these moves with some fiscal moves. So for instance, import duties on non-essentials. We had $95 billion of imports last calendar year of consumer electronics and those kinds of products. Now, do we really need to mollycoddle consumers at this time when we have an economic crisis? We need to increase import duties, and that would save at least $10 billion of foreign currency. Then if you were to aggressively reduce fuel and fertilizer subsidies, the government is embarked on this program anyway, but aggressively announce a target of reducing it to zero over the next 2 years, it will dramatically change sentiment for the better. And of course, exports will pick up. India is competitive now. And if you open up FDI in defense, we can create jobs in India. There's a humongous opportunity to create jobs in India in the defense sector. Why should we restrict ownership to 26%? We are exporting jobs to Israel and France, whereas those products could be manufactured here with maybe 100% ownership, but technology would be transferred to Indians in India, and manufacturing jobs would be transferred to Indians in India.
Pradeep, post the RBI allowing forex swaps for PSU OMCs, the rupee has gained considerably, about almost 3 to 4% after breaching the 68 mark. Do you think, A, these gains are sustainable, and what, according to you, is the fundamental value on an average basis for the currency? What, according to you, would be a stable level?
You know, where we went wrong was allowing the rupee to appreciate. 2 years ago, the rupee went to about 44 rupees to the dollar, which was completely unjustified. And from then on, it's depreciated by 50%. So we think it's depreciated a lot. But as I said, this was a catch-up because of the inflation differentials and also because of the current account deficit. So we have caught up. Now, we can overshoot and deteriorate further. And as you know, currency depreciation also feeds into inflation. So we can actually cause further problems for ourselves. But here's where the opportunity to bring back investor confidence and therefore bring in FII flows. We have trillions of dollars sloshing around in the Western world. As interest rates rise in the Western world, the Western markets will take a beating. And here's an opportunity to show that we have growth. Yes, this year might be under 5%, but we will go back to that 8% growth because of lower interest rates. So investment demand will be kick-started, consumer demand will be kick-started. And that attraction of growth will bring FII into the country, and that is what kept our currency strong. It was not current account surpluses, it was capital inflows on FII and FDI that kept our currency protected.
Pradeep, but do you think the perception for Indian markets has taken a hard knock, at least from an emerging market standpoint? Because high crude prices will only benefit Russia and Brazil. And given the way China has improved off late, do you think in the near term Indian markets could suffer more?
We could suffer if we further lose investor confidence. You see, we've introduced a food bill. I mean, I'm not debating the merit or anything of it, but it adds to the fiscal deficit. Now, if we were to, in a compensating measure, aggressively reduce fuel and fertilizer subsidies, as I said, the government has embarked on this program, then we can tell the world that, look, our fiscal deficit will remain under control. Then similarly, for current account deficit, we open up the FCNR tab, bring back investor confidence through lower interest rates. We can attract flows of money into FII investments and into FDI investments. And that itself can dramatically improve the currency. And confidence would come back because we will have underlying growth. Look at our agriculture this year. We will grow at about 4%. And the linkages of agriculture to industry will result in far greater growth in industry also. So we have a strong base. I know we have infrastructure problems. I know we have lots of problems. But we have entrepreneurship and we have competent leaders in our country in industry and business. And services, tourism will take a big surge if we open up the tap for visas and so on and allow tourists to come in freely. So we can really dramatically improve our current account deficit by exports and of goods and services and tourism. And we really can tide this problem over. We need leadership at this time.
Well, markets are down, but Ranbaxy is the first one to bounce back. 436 rupees for Ranbaxy, up 60% in 1 month, and it is still going up on a bad day. So this is strength, and this is, and today's price action in Ranbaxy is some kind of an indication that in the short term, the scales clearly are tilted in favor of going long for Ranbaxy. Pradeep, in an environment when rupee is down and dollar is up, the best trade is that you buy into exporters. But do you think somewhere buying into exporters or pharma or IT is now becoming more like a crowded trade because just about everyone is long IT stocks, just about every brokerage is bullish on IT stocks, and all the funds now either they are overweight or market weight on IT?
Yes, I think we can exceed, and especially because people are not doing research and going into the second tier scripts. We are all concentrating on the nifty or the most liquid or the most visible scripts, but there's a large range of other pharmaceutical companies, for instance, and which are still going at affordable valuations, not necessarily cheap, but still reasonable valuations. Whether you take mid-cap companies like Torrent Pharma and so on, there is opportunity to make money even in those companies. So I say that Indian market offers great value picks, and at this time, contrarian strategy, going even a little bit lower in size, can, for individuals in particular and some of the smaller funds, be a wonderful opportunity.
Pradeep, what about the beaten end of the market? Because 80% of the market is trading at historic low, and eventually Indian economy will bounce back. Now it's debatable whether the turnaround will happen in this quarter, next quarter, it will happen next year, but eventually the cycle will reverse, and when cycle will reverse, banks, especially PSU banks and capital goods stocks, will be the first one to bounce back.
They should bounce back. In the case of the PSU banks, there is a lot of structural damage. They went into project finance in a big way. Many of these big projects are stuck. They will have to take haircuts in those projects. They have been indiscriminate in their lending. You look at the private sector banks, whether it's an HDFC or the IndAsia or ING or so. They have been very careful in their lending, and therefore They built up a retail portfolio which is much more stable, much more robust in terms of quality, whereas the public sector banks are willing to give wholesale money with less regard to quality, and that is where their problem has arisen. Otherwise, fundamentally, they have the ability to attract deposits. They can attract actually cheap money too. But where they've gone wrong is in the lending side. And I think that is where RBI should have concentrated not on increasing indiscriminately interest rates, but concentrating on improving governance at our public sector banks.
Pradeep, really good having you on the show with us. Thanks for taking time out and joining in.